Nothing said on Empire is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed.
Hello, world. Are we live, Rob?
We're live. Let's rip it.
You look different, man. You get a haircut. Is it because you...
I've been in Miami. I'm getting a little bit of tan, get the haircut. I'm just trying to avoid the blizzard. So I'm living my best life right now.
There you go. What's going on this week?
It's, for a second yesterday, the market was back. And now it is dead again, unfortunately. Otherwise, it's been, kind of an interesting week on the stablecoin side, right? So we've got, Facebook and Meta saying that they're going to get involved in stablecoins again. We have the Luna Jane Street drama. Now we should talk about that. That's a little bit interesting. Yeah. And then Tether investing in Whop. That's pretty interesting too. So like most weeks, it's stablecoins and not a lot else. It feels like.
Yeah. Promise you folks, we're not having an existential crisis here with lack of news. Honestly, this is where it's like gets really interesting to build. No one pays attention to the state of the news, but why don't we run through that? Like, where do we want to start first? Terra, Jane Street.
I think the Jane Street stuff is probably the most interesting, and that's been all over the timeline. But I don't know if you've been keeping up on it.
Oh well, it reads like horror / thriller, so I figured you'd pick up on that one. So why don't you walk us through that? I did read some of that, not entirely new, because there had always been, rumors and hearsay about what had happened. But yeah, why don't you start and then I can layer in my thoughts.
Yeah. So for context for the listeners, there's a couple of things that are happening here, but it started, to your point, with at least coming back to the public consciousness around the bankruptcy administrator for the Terraform Labs that guy who is doing that administration, it basically filed a lawsuit against Jane Street, alleging that they improperly used inside information to front run some trades and accelerated the collapse of UST, and that they illegally profited off of it. And so they're trying to claw back for all the creditors some amount of ill-gotten gains, essentially, right? And so that was what kind of brought it back to the public consciousness. I have an opinion about that, but then following that, there's been all of this stuff on the timeline about how, there's a sell wall at 10 a.m. every day, and it's definitely Jane Street, and they're artificially keeping the price of Bitcoin down. It's which is something else entirely. And I think, as I put it to one person who asked me, kind of completely misunderstands the role of APs and of how derivatives work. But I think people just want somebody to blame for not making more money and Bitcoin not being higher. So I have opinions on both sides of this, but I think that on the insider information stuff and doing insider trading, there's a couple key points that I think are worth pointing out, which is one, that this is not new. This has been part of some of the public record for a while. And if you actually look at the filing, which I tweeted out, there's the vast majority of it was redacted, actually. So there's basically, I would bet maybe only 30 to 40% of it is actually able to be read right now. And if you look at what is able to be read, the main allegation is that at one point, Terraform Labs pulled $150 million of UST out of a curve pool. And then 10 minutes later, Jane Street also pulled a significant amount of UST, I think it was 80 million or so, out of a curve pool as well, and market sold it. And that then I think they also maybe shorted it as well. And so maybe they profited from the short, and then they also, by selling the long, contributed to the collapse of UST and Terraform. And also, I guess, they did this before Terra went out and made like a public announcement, but it was 10 minutes after they had, taken the capital out of the curve pool. And so that brings to question, whether or not the fact that they did this 10 minutes later on a public blockchain when anybody could see it, and they were obviously sophisticated enough to have, been able to have the right notices in place when something like this was happening, whether or not that could be insider trading. I guess it does depend on, what they were told beforehand and were they like ready for this. But it, based on what we know, that's very clearly is not. The other problem here is whether or not, there's insider trading outside of securities laws, but UST is pretty obviously not a security. I think there was a SEC lawyer in a through a court, one of the judges said that UST with being an anchor protocol and guaranteeing you 20% was an investment contract, but by itself, it is not. And so there's a lot to kind of go through here, but it seems to me like it's a little bit of people looking for a boogeyman at a time when markets aren't doing what they want.
Yeah, I mean, there's a lot to unpack. Like, I think it's not the first time that I think this administrator has gone after some people because obviously, look, it was a spectacular collapse. I think there was like a four. He's there's a $40 billion wreckage, and a lot of that you could argue retail got hurt. So someone's going to go and go after it. So for context, again, I think you mentioned it, but it's worth highlighting. It's the Terraform Labs bankruptcy administrator, this guy Todd Snyder. He's saying, "Hey, what can I recover? How can I improve the recovery rate?" And of course, he brought in this suit against Jane Street, right? Um, and I think the observation you made, which is this insider trading or not, and what constitutes it, is pretty important. I don't think it. I mean, this is obviously a pretty interesting one because let's just play this out. What would Jane's was it Jane Street or Jump?
It was Jane Street in this case, but I mean, Jump obviously has also been entangled in this
It's
whole thing.
involved,
So
right? But if you're Jane Street, what could you say in your defense? You'd say, well, this happened in a public blockchain. We saw that, and then even though we were contacted, anyone out there could have seen that and done the same thing that we did. And we're sophisticated because we have alerts and we're quant shops, so we're on top of it, and we move fast when we saw that. And I think that's like a credible defense. Right? I mean, these are all things happening in the public, um, blockchain, anyone to inspect. Where I think it gets a little bit messier is like the communication that Doe had directly with them. I don't know what you make of that. I'm actually curious in your perspective because, like, from your seat, you're in touch with the founders of these protocols, and you also have a liquid instrument, a token that you can buy and sell, and um, how do you guys, I guess, handle that internally? Like, for instance, if you have a huge stake in Athena or Hyperliquid, and you then have a conversation with the team. I presumably think, do you guys have like some sort of policy around like determining what is MMPI? Do you take the position it's commodities? Like what? I've seen like it all when it comes to compliance in investing firms. I'm curious how you guys kind of think about this, like, and how to handle this kind of like sensitive information.
I mean, it's worth noting, by the way, that even in commodities or the CFTC, there is insider trading, right? And the definition is slightly different. It depends a lot around, information and how it's been disseminated, and then other things that are certainly carved out, like in like land deals, of course, like there's there's like a set of things that you have to tell everybody, but then there's a bunch of things that you can technically insider trade in land, and so it's a lot of it is around what the agreement is and what you owe to your place of employment. And then there's also so that's the legal point. But then there's also we consider a lot like, okay, well, how do things look, right? Like, what would people think? What would they say if we were doing it? And so for us, we take a very conservative perspective, which is that if we know of something that is going to happen with a protocol, which we do, of course, right? Because we invest in these companies and these protocols that are going to launch new products, and theoretically the market's going to react well to those products. But once we know those things, we put them on basically like a blacklist, and we're not allowed to trade them. So we won't trade them at the fund, and then we also restrict everybody at the firm from being able to trade those things personally. And so we're very strict about that. Typically, also, if we own really large positions of a single token, we just don't let anybody at the firm own them anyways. So, like for ENA, for instance, people at the firm shouldn't be buying and selling ENA. You have to go through an approval process with our compliance team and all that kind of stuff, because we don't want there to be any kind of show of impropriety. I think in the Jane Street example, to your point, they had a chat set up on Telegram with the Terraform Labs team, and one of the interns had kind of worked at he had worked at interned I think at Jane Street and had worked at Terraform, and so it's like very unclear based on the filing what was being said back and forth. Having the chat itself is fine, right? So we have chats with a lot of people. What was said and how were they tipped off and what did they know? That could theoretically constitute some sort of having knowledge that they shouldn't have, and then uh, there is, while not set in law within commodities, there is sometimes a presumption that you should wait until information is fully, kind of fully out there and disseminated. In securities specifically, that's more of it's kind of more of a settled law. And what we see for companies is they actually there's this like cooling off period for a couple days post earnings where you're like not allowed to trade whatsoever. In commodities, there is no call it 2 day commonplace kind of agreement with everybody. And it's really up to like common sense whether or not you think that information has been disseminated enough, even if you knew it beforehand, to not be insider trading. I think Jane's perspective here, even if they did know that there was, they were going to pull this capital out of curve and that, there was a hole in the balance sheet, they might say that, listen, like this is a public blockchain. We gave them 10 minutes before we did this. Everybody knew. And then you would have to make the argument whether or not that was true or not, or whether or not that was enough time. But it's also not clear whether or not they knew this going ahead. So if they didn't know, then this is definitely obviously not a problem.
I think there's a couple of things that could come out of this case. One obviously is this insider definition in crypto that could set a precedent. Like, you know, there's people that have strictly said, "Hey, this is a commodity; it's not a security." So, to your point, I mean, I think you and I were both in the room when Commissioner Seelig said, like the CFTC. I think a lot of people would be surprised to hear that the CFTC also has insider trading and market manipulation rules, and I think it's both insider and market manipulation here in this allegation that I think
Yep.
would set a pretty interesting standard. Because part of the complaint from this administrator was, "Hey, you guys like caused the collapse of this network," which to me is also pretty interesting. I think I thought about that guy who exploited, I think Aave, I forget his name was. He's a pretty sophisticated quant says, look, there's a pretty faulty piece of code here or risk parameter that he exploited. I think it was like some sort of flash loan. And I forget what the ruling was on that. I think initially he was like guilty and then he got released. But I think this is pretty
That's
interesting
true.
because
I thought he was just guilty. I mean, in that case, like it's different, right? So he stole capital from people that like, it didn't belong to them, right? And so he used this like flash loan mechanism to like drain the pools, but like the pools had other people's money in them, right? It was not his money, right? And so it,
his definition of stealing was different. I don't know. We'll have to look like as we record this if that was the case because I thought he was like like they reversed the ruling. Um, but we can maybe fact check that while we're live. Anyways, in this case, like I think the argument someone could make is like, hey, look, Jane Street accelerated the collapse of Terra, and that caused like 40 billion of like the DPEG and the spiraling out of control. It's actually like to me that's like really fascinating, which is like Soros as an example. He shorted the British pound
yep.
and made a killing on it. I think he made over $1 billion. It was like a trade of a century. Uh, is that any different when what happened here? Like you could argue like, hey, look, the monetary like the particular currency is fragile or they're like holding the peg or whatever, and then you have an arbitrator like Soros come in and make a profit off of that. I mean, even I think there are some markets that have prohibited short sellers because they're like, hey, you're profiting on the collapse of a system. You shouldn't be able to do that. the argument in the US is like, no, like you should allow short selling because it just creates more like market efficiency and price discovery and whatnot. In this case, like I think everyone actually, my opinion is like we've all known that like stable coins, like synthetic stable coins are pretty fragile and can one of the major risks is this, which is like the DPEG and spiraling out of control. Um, the more nuanced thing is like, does retail actually understand that that's a big risk? And I think it's like, if you're a platform like an exchange or a wallet that is advertising like a risk-free like yield on the stable coin, well, first of all, I think you shouldn't call it a stable coin.
Yeah.
So like okay, like I think relevant to you guys, like Athena, right? Is Athena a stable coin? I think it's a it's a tokenized fund, right? It's basically like, like you could take the position like it's not USDC. It maintains its stability.
Well, this is why, I mean, so this is why in Genius, people are trying to make the point around Genius Act, or sorry, and within the Genius Act, they're trying to make the point around like payment stable coins and, OCC regulated stable coins or Genius compliant stable coins versus others. In and under MiCA, the European Union actually talks about three different types of stable coins. One that are the equivalent of what we're calling payment stable coins. So fully collateralized, money market funds, etc. And then they talk about two other types. One are which are kind of like exogenously or differently collateralized, something not by money market funds or etc. And so I do think it is important that nomenclature matters. Like we can debate what the taxonomy should be. Clearly there's a lot of concern around things like Terra and others being called stable coins when they have different types of mechanisms underneath them that are not just fully collateralized. And we do need to make sure that we um, talk about them differently and that we put appropriate kind of disclaimers in place. So I totally agree with you. What exactly that terminology is, I think some people try to say yield coins or whatever. I'm open to, but I'm with you. I think there's I would make a couple of points. So first, I'm gonna good on you that I didn't actually know. So Avi Eisenberg was actually he was actually convicted, and then he had his conviction for his basically for the exploit actually overturned. So you remember that, right? I did not remember that because he was convicted originally of like wire fraud and market manipulation in 2024. In 25, like a little less than a year ago, he was it was vacated because for two main reasons. One was that the judge said that there was a venue failure, so he was in Puerto Rico, so the SDNY didn't have the ability to actually go and try him, and then they also said that they couldn't find kind of reason to believe that there was actually wire fraud. But he's actually still in jail because when they went and executed the
Yeah,
warrant.
they found like child pornography or something.
Yeah,
Like
they
that.
found child pornography. So he's in
Yeah,
jail for child pornography. So
like,
yeah.
but this like so when I met Doe in the early days. There's reasons why I never invested in him because he was just never the kind of person that could furnish information. I would ask really basic questions, and mind you, I'd invested in a number of synthetic like stablecoins at Basis, um, and I'd invested in synthetics, which is Haven. So he basically copied Haven, and like I talked to Ken, I was like, oh, this guy's like just copying what we're trying to do. And Doe is like a masterful person that he would never give you like a good response to a very basic question. Like when he was fabricating the chai numbers, I was going out and talking to like folks in South Korea and saying, hey, like, is this actually real? And I could never find truth to that. I think there's like a couple of things here worth pointing out. One is, you know, it pays to do the work um, around like validating what these networks are, posting. A lot of the transactions that are posted on chain cannot be fabricated. In the case of Terra, I was like I don't think anyone like was able to really validate that. Most of the funds and even retail certainly like they just love the trade. It was paying like a pretty juicy yield. And I always go back to if you don't know where the yield's coming from, like you are the yield. And there are likely more sophisticated players in this market, like Jane Street or like Jump that just know how to operate and play this game better. And playing the arbitrage game is pretty dangerous, I think. Um, I guess going back to my observation around like Soros, like he shorted the pound because he said, look, it's unsustainable. They can't, they keep defending the peg. That's got to break. I think what the administrator here of Terraform would say is like, yeah, but Soros didn't have like a mole inside the government that told him that like they were going to do it. And I think that's a big part of the argument here. It's just like this intern that had in communication with the Terraform team. And
Yeah.
um, I think that's something that as an industry, you can probably do a better job of information disclosures. Like, okay, like if a team is going to announce something, currently they do it somewhere along like either Twitter or Discord, but it's not like a unified method to communicate with your token holders. And I mean, part of, I think the token transparency initiative by Blockworks, I mean, I remember calling Yana, talking to him in New York and said, someone's got to do it. Like, we got to like self-regulate as an industry to like improve communication. And, you know, that I think independently of where regulation shakes out, I think we can all agree that it would be hugely beneficial for the industry if we had like, in a perfect world, Terra would have communicated this to everyone and everyone had like perfect information that they were withdrawing from the curve pool, like a huge amount or something like that, right?
Yeah.
Uh,
No, I'm with you. I think, listen, on the market manipulation point, I mean, this is also tough, right? So we've had a lot of this conversation in crypto. I mean, like in the Mango Markets thing with Avi Eisenberg, like, he was putting like spoofed transactions in there, right, to artificially inflate the price, right? And clearly like wash trading, spoofing, like that type of stuff, like that is market manipulation. If you know, Jane Street was simply just selling UST that they held or like shorting UST, right? Like that's clearly not in and of itself market manipulation, right? Even if that just because they're just, getting out of
just had a
a
big
long or
actor that owned. It's like if China dumps treasuries tomorrow, well, that's going to have a.
it's gonna have you among its impact, right? I mean, we've seen, the unwind of the, Japanese carry trade, right? Like that is not market manipulation just because people want to get out of or like, running for the door when there's a fire.
Even 2 or 3 years ago, like the British pound, like suffered a pretty big depreciation because like there was like thin liquidity in the what is it, the gilt market or whatever.
Yeah, in the gilt market. Yeah, that's right.
Yeah, but like the Avi poison is really interesting. There's 2 points here. One, the judge, to your point, said we don't have jurisdiction because it happened in Puerto Rico over a decentralized protocol. So the SDNY does not have jurisdiction. That's like less interesting. What's really interesting is they basically said there's no fraud here, even though he spoofed and he manipulated the market and used flash loans um, to enrich himself. But he basically exploited a fault in the protocol. And he said Mango Markets had no terms of service, no prohibition against manipulation, no requirement the loans be repaid. Basically, like no rules governing borrowing. And that I find that pretty interesting because you would argue that in traditional markets, like this is well understood. Like I guess like you don't need to post like what is common knowledge that you shouldn't be doing these things, but the fact that the ruling was pretty clear that like it was on Mango Markets to like explicitly have like the terms of service. It is pretty. I guess I don't know if other protocols have like adapted to this, right? Some protocols have you make you click through a terms of service, but I think not all of them.
I mean, most of the ones these days do, especially if they eventually want to serve, call it not just US, but like EU and like more like, regulated markets. But I also think like, listen, it, with Anchor and with UST, there was also like Doe was putting out a bunch of false information the entire time, right? And like, he was lying to the market, and they had this like guaranteed, 20% return, which was clearly offering an investment contract. And so it's to me, it's there's two different things happening here. One, which because like Anchor was clearly not a decentralized protocol in the way that it was operated and like the things that they were doing, right? Whereas in Mango, I think is obviously, quite.
Mango wasn't as like you could. I guess the reason why Avi got away or just got overturned is because this is sort of like the code is law. And I think I remember like the lawyer of Avi and even Avi like publicly saying like I basically used the protocol as designed and I didn't break any rules. Like I this is the code and if code is law, then I didn't do anything that was like out of the ordinary. It was like these were the rules and it's codified. Anyone could have done this and I just, I didn't do anything that wasn't, I didn't act like I didn't break a term, like there weren't terms of service, but even if there were, like I use the protocol as designed. So therefore I should, like there's no wrongdoing here, which um, is interesting for the code is law kind of camp of people that come into crypto and say like, sort of, if it's codified and you're working within the code, then, you know, those are the rules of engagement and call it a day. Which
Yeah.
I candidly don't agree with. I think like there's common knowledge and ways of operating from traditional markets that should apply to crypto, even though
Yeah,
you've
it
codified
definitely
something.
can't just be like, "Oh, code is law." So if, I steal somebody else's money, but it was a bug in the code, then like, whatever, that's fine. We very clearly see this in traditional markets where like if you hack somebody, right, the code is not law if you hack a centralized counterparty, right? And so I don't know. That's always. I also think this is probably not going to be a big of an issue in the future, or maybe as as AI continues to proliferate, right? Like you've seen all of these announcements with OpenAI, and you talk to all of the security companies right now. They're all using AI to do these security audits, and I think we're not that far away from security AI assisted and maybe fully autonomously AI security audits are far better than anything we did in just call it in the audit world before we had the proliferation of these kind of much more powerful foundational models. And so maybe this is like kind of a mute point pretty soon.
You would hope. I think hypothetically, what if you designed the AI to do not white hacking, but like just exploit these systems?
Yeah, I mean you're gonna have both, right? Which is why you need it.
Yeah, bro. I mean, I think there was Claude, I think was or Anthropic was only cracked down on like people using um their models for like nefarious activity, and they clamped down on it. I think it
Well,
was
they all are because they don't. Yeah, and so you have to go to one of these one of these models that are not censored, which are, not at the cutting edge at the moment. But you can access them, and there are people that are accessing them. As I understand it, there's a couple of these kind of like decentralized. There's also like a decentralized access point, like I believe there's one that in crypto that has a token. VVV is the token where I think you can use either censored or non-censored models, and there's also privacy. But if you use the non-censored models, like most people are really just using it for porn right now, I think, because like you can't use OpenAI or Anthropic for porn at the moment. But like I'm sure they're being used for other. I mean, I'm certain they're being used for other nefarious activities as well.
yeah. All right, enough of this. It's going to be an interesting case. I don't know when it's going to be resolved, but nonetheless, it is one of the more like to be resolved issues when crypto. But on like commodities, securities, what's the rules of engagement? I think it will. If I were to guess, it's really just going to come down to the nature of the information that they received, not so much that they withdrew from the pool. I think the argument around it causing a spiral is baseless, right? They were a big player, and anyone could understand that. It was just concentrated, and um, I don't think that has merit or grounds. But what does is if you had certain information ahead of others, and whether you were managing $1 billion in the protocol or much less than that, you know, I think that the law is. I mean, how it gets interpreted in the court of law is going to be pretty precedent setting for the rest of the industry.
Yeah. Yeah, absolutely.
Coinbase crypto-backed loans powered by Morpho empower users to borrow up to $5 million using Bitcoin or $1 million using ETH as collateral. Loans originate in seconds with no additional credit checks and competitive rates typically between 4 to 8%. Use USDC for down payments, debt refinancing, unexpected bills, and more. Repayment anytime with no fixed deadlines. Over $1 billion in loans have been opened through Coinbase to date. With the Coinbase app, you can manage crypto-backed loans with ease. To learn more, click the link in the show notes. As always, investments in blockchain technology involve risk, terms, and conditions apply. The Blockworks Digital Asset Summit is back in New York, March 24th through 26th. We'll have top speakers from leading asset managers, financial institutions, DeFi protocols, crypto companies, and policymakers all under one roof. Think BlackRock, Coinbase, Robinhood, and more. Follow the link in today's show notes to buy tickets and make sure to use code Empire 200 for $200 off at checkout.
What's next on the list? I mean, we had
There's so much stablecoin news. We've got Meta, we've got Tether investing into Whop, we have Circle earnings. I think the Circle stock price in the last couple of days is up from $60 to almost 90 on that. So
they
it's
up 35%. What's a skinny? Why don't we just go to that? They posted earnings per share 43 cents in the fourth quarter, beating consensus estimate of 16 cents.
yeah,
Shares are up 35%.
it's sort of interesting. I'd have to go back and look at some of the analyst notes. What really surprised people is like obviously you can look at the amount of USDC outstanding, and that is in real time. Like you should have a really good understanding of the amount of in circulation. But what people really missed was that they missed that there was a better mix shift for Circle. So a lot more of the USDC was off platform. And so they were getting a higher share of the revenue because obviously when it's on Coinbase, they have to give 50% of all that revenue to Coinbase. Or sorry, they have to give 100% of that revenue to Coinbase when it's on Coinbase. So it ends up being often quite a large amount of their revenue because it's 100% of that, and it's 50% of everything off Coinbase. So they had this better mix shift. They didn't end up having to share as much of the yield as I think people thought with the other platforms that they're on. Their expenses didn't kind of raise quite as high, and they told a really awesome story again about the future of stablecoins, which I fully believe in. I know you fully believe in, and what they're. I think they also surprised a little bit on the CPN side. They're doing something like 500 million a month of volume on CPN, which was higher than people had expected. A lot of financial institutions.
For people who don't know that, what's CPM?
It's the Circle Payment Network, which is sort of
They onboarded a ton of like a few institutions there. I think,
yeah,
right?
it's some big financial institutions. I think Standard Chartered is on there, a number of others, and then a lot of the the names that you would know that are like the service providers, like the orchestrators, the conduits and BVNKs and yellow cards of the world are
Okay,
all.
would you say that the CPN is like one of those things that is widely perhaps underappreciated or not fully understood of what it will do to the business model? Because I'm reading here like the company said the CPN expanded with the enrollment of 55 financial institutions and another 74 going through the eligibility process as of February 20th. So presumably, like that is a pretty strong signal. Like a lot of institutions want to get onboarded, and they see as like because I guess the criticism around Circle's model is that it's a thin moat. Financial institutions are going to launch their own stablecoin, and that eats into Circle's business model. Um, but what you're seeing now is sort of a pretty interesting network effect, if you will, where you have these financial institutions just say, hey, we're going to want to use USDC and we want to be part of their payment network.
Okay. Yeah, listen, I think my perspective here has been that there's basically two sides of the network, right? There's a quoter, somebody who like is receiving flow coming in, and they're saying, okay, I'll pay X amount, or you have to pay X amount for that flow, and then there's the person like sending the flow, right? And my general perspective this whole time has been that it makes a lot of sense for everyone who wants to quote, right? I think they have these terms like an OFI and a BFI, but if you want to quote, of course you'd want to be there, right? It's a new potential, flow source, right? It's like new business for you, right? But if you're sending the flow, potentially you want to be on platform because you don't have the right connectivity to, these different corridors or these different regions. But as you grow, as you get a lot bigger, you might want to just have direct connectivity in those regions because if you're doing a lot of volume, you will probably get better pricing, right? Well, the counter argument to that is like, well, maybe they're going to give you better quotes through CPN because of call it some value added services that they put on top, whether it's identity or account reconciliation, things like that, things that are still really hard. Or just like we have so much flow coming through CPN, we'll give everybody in the CPN network better better pricing. Today, as I understand it, and this isn't public, but as I talk to people, the pricing is not better, right? And so I think for some of these people, it's trust, right? Because they trust Circle as a counterparty, and they know they can sue them if something happens. Relative to some of these, call it smaller companies that they don't want to take the counterparty risk as much, or they don't know if they can trust them. So the fact that they've been able to, with that, be able to get as much volume as they have, I think is pretty a little bit surprising to me, but is a really good tailwind behind that business. The question for me will be, how do they compete as it gets a lot bigger? Maybe there's network effects, but also maybe people want to come outside of that. Outside of that, but I think people were pleasantly surprised by kind of the current traction so far. They're not monetizing it today, so it doesn't really matter for at least in terms of like being a payment company. Now, maybe it means that there's more Circle USDC outstanding, and so they monetize it indirectly through that. But we'll have to see how it evolves. But overall, like, listen, it was a really good quarter for them, and I think the market looks at this and is, excited about the future of stablecoins, and Circle being kind of the only pure play way to play that in the public markets.
They have 55 financial institutions, up from 29 the prior quarter. These include like Santander, Deutsche Bank, Societe Generale, like a lot, like Standard Charter, some other like crypto companies, like including yours truly, Conduit, and they're mostly focusing on high value, underserved global trade corridors where access to dollars is expensive and slow. So not like the US Euro corridor or Euro or US yen. It's like exotics probably. And to your point, they're only facilitating the messaging. But hypothetically, like I'm walking through like a practical example here. So like if a fintech in the US needs to send like $1,000 to a bank in the Philippines through one API call, like this CPN pings multiple BFIs in the Philippines for FX quotes, it locks in the rate, and the OFI, the originator, selects the best quote. And it's more of like a compliance thing. I think they do a lot of the compliance. Data is exchanged, encrypted. You're compliant with like travel rule information. And once that's approved, like the USDC is transferred and settled in minutes. So I guess this is not so much like it is a payment network, but it's also more the compliance piece around it and the convenience factor of doing it.
Yeah, I mean, there's this thing that's happened and this has really changed a lot over the last year, but when they announced this, but a lot of the fintechs more broadly, this is not a crypto specific thing, but there's this thing called nested flows versus non-nested flows, right? And so when you do, you have to have some sort of receiving bank on the end if you're going to do anything touching fiat, and if you, as part of that, you had to do KYB. That's at least up to some bank standards. And a lot of stablecoin companies, but a lot of also like just traditional fintech payment companies would do what they call nested flows, which is that they wouldn't necessarily know who the end customer is. There'd be actually like, some sort of local customer that then was facing off against another fintech, who was then facing off against another fintech, who was then facing off against the bank. And the bank wouldn't be able to tell who the end customer was. And the that type of like nested flow, I think, has gotten a lot of the banks a little bit concerned about who they're ultimately doing business with. And there's been this thing called the reliance model where, essentially you're saying, well, I'm the bank. I rely on this fintech to having done the work. Well, that fintech is relying on the other fintech to having done the KYB work and anti-sanctions work. And then that fintech, is the one ultimately facing. So people have different standards, and also, sometimes there's bad actors, right? And so a lot of the banks in the US and a lot of the, fintechs in the US over the last year, and a lot of stablecoin companies over the last year, have tried to do this quote unquote denesting, which is basically just make people have to onboard directly so that they can pass this information about KYB, around compliance, et cetera. And so we've seen a lot of that happen in stablecoins. And obviously, CPN requires you to do that today. And so, that's, I think, helpful. But again, like, as Bridge or BVNK or Conduit, these guys denest as well, they're going to have to be able to do the same work. So there is a bit of still I think a sort of a difference of incentives or incentive misalignment over time. But listen, kudos to Circle. Like they've done a great job so far.
You're not going to ask the question, but like, would you rather own Circle or Stripe equity?
Well, that's a good one. Stripe at 100 47 billion or 57 billion, whatever it is kind of insane. I mean, they're growing like tremendously, but is it worth 5 times that as much as Adyen? I don't know. Yeah, it's a, different business. Listen, the Collison brothers, like, I would never bet against them. If there's gonna be a trillion-dollar payment company, you sort of think that they're gonna be the one, clearly. I do find that they are really good storytellers, and sometimes better storytellers than they are, um, they're early to things, but then they are, enacting some of these things. But listen, it's hard to bet against them, and so I would probably rather own Stripe still because I think the, stablecoin issuer market is going to get a lot more competitive. Whereas, and I think Stripe is already in a very competitive market and they're just, mogging people right now. Uh, so probably, but listen, they're both doing a great job.
Circle market cap 20 billion. Stock is down from its all-time high of 276. I think when it hit 250, I said I'm gonna use all my newly raised funds and conversion and short the stock. And to which point I think you were seriously reconsidering why you'd funded us, but
That's
would have
true.
been a great trade nonetheless. Yeah, I'm curious.
Absolute returns are not what matters, Sati. That's why they call it hedge funds.
Yeah, I guess sometimes I listened, by the way, content of the week with the D1 interview from Invest Like the Best talked about this exactly, which is sometimes your investors will punish you for actually having a better return because they'll say you've just like gone out like the deep end of the risk spectrum and you were just kind of lucky and they're really worried about doing that.
People would much rather have a really good total return strategy. A lot of institutional investors, total return strategy, where it's a lot more easily quantifiable and that they can more easily forecast it than do something that's like crazy and has this huge return, but like feels like maybe it was lucky or maybe it was some maybe it's not repeatable. Yeah.
Or in the long run, we're all dead and everyone mean reverts, and so just make money if you can. Don't blow
I mean,
up.
I was at a like a GPLP event in Miami this week, and one of the things that we were talking about is like why can't liquid funds in crypto raise capital, and why has it been so hard to make money as a liquid fund in crypto? And one of the GP or one of the LPs said, "Listen, like there's this idea right now around one is like everything's too correlated, and so there's you know, it's hard to like really pick, a one, liquid fund from another and, that everything goes up and down together. But two, if everything goes down 40% and my liquid fund manager only goes down 20%, that's not great. Like that's like I don't want to be in that fund either, right? I feel lucky. I don't feel like that type of outperformance is repeatable, right? And so it talked a little bit about the sentiment with in the LP space around the liquid funds, which is like there's just too much volatility in the space generally for a lot of the institutional LPs to get excited, even if you're outperforming.
Yeah, I think depends who your LP is, but what I can tell you is from my perspective, I appreciated LPs really want to see through cycle performance. Of course, if you're a venture fund, you hide on the mark, you don't have a liquid position. But in crypto, I think that's the challenge is that you're a venture fund with a 10-year fund, but you have locked vesting positions, or part of it is still vesting, and you have to mark that some way. I think you could say no, we're just going to hold it at cost, but the rules don't allow you to do that because I think it's not as easy as saying, hey, it's locked, I'm just going to keep it at cost. You have to have some reasonable valuation methodology, and your LP is going to still see the volatility in his NAV report, whether they have liquidity or not. I heard it from one guy who was like, I actually hate crypto funds because in many ways I don't want you to send me the NAV report on a monthly or quarterly basis. I'd rather you just wake me up in 5 or 10 years and give me the absolute return. I don't want to understand what happened in the interim. Because his point was like, it just makes my life very complicated and difficult because I have to go to investment committee and report our holdings. And one quarter I'm a genius, and 6 months down the road, they hate me because it's just so much volatility. It's kind of an interesting game of allocators. Like LPs would rather would rather get a 2x than a 5x with volatility.
Oh yeah. Well, this the same event that I was at, we're talking about VC funds too, and it's funny because if you look at the last X amount of years of crypto venture, only in the last like year and a half has like equity overtaken token investing or token project investing, right? And some of those token forward like DeFi funds, et cetera, have made a lot of money for people. But I was talking to these LPs and they were like, listen, we would rather do a crypto focused equity only fund if it had still had decent returns because there's this volatility laundering that people talk about with venture, but like that's a feature. Like we want that volatility laundering to the point that you just made, right? Because there's all this talk about how venture is and being private is, basically just like not it's just not reporting on the volatility, but the volatility still exists, right? But it's just not you don't have this mark to market all the time. And now that's a bad thing. But I think for a lot of the capital allocators, it's a good thing. And so there's a bit of I think this dislocation between the way people talk about these things online and the way the LPs actually care about it because people do not like volatility. Like it is just a human nature. They don't like it.
Yep, they ascribe volatility to risk, which is not the same thing. Yeah. Can we talk? Speaking of, I was just looking at an announcement by Vlad Robinhood. We've talked about at this podcast before that they wanted to like tokenize shares in private companies, including Stripe. That was like a terrible miscommunication. They've now come back to I think raise $1 billion for their venture fund. Can we just like talk about that? I think you'd find it pretty interesting.
Yeah, it's interesting, right? So they raised $1 billion. It IPO'd on NYSE, I think at $25 a share, right? And it owns Databricks, it owns Stripe, it owns SpaceX, some other private companies, and it's going to be a traditional like publicly traded closed-end fund.
I thought it was so Robinhood Venture Fund 1. It's $1 billion closed-end fund and it's publicly listed.
Yeah, I think it's publicly they IPO'd, right?
Yeah,
So
the fund is you're right. The fund is being offered through an IPO structure. It's going to have positions in SpaceX, Stripe, Databricks. Interesting.
yeah, so they went and it's a traditional, and so it's easier for them, right? So for Robinhood, they can do this closed-end fund. They can buy these late-stage private companies, the equity in them, and then they can go and they can offer it as through their traditional brokerage product to all of their customers because it's just a public company, right? So it's very easy for them to distribute it to everybody. And I think they also have Airwallex, Ramp, and a few others, right? Revolut. And so it's actually, it's a traditional, kind of structure. There's a lot of people who try to do this, right? On this, like, public closed-end fund. The question will be, of course, like, how does this thing trade relative to NAV? And how do you strike NAV, right? And so that's always the problem. Again, we just talked about volatility laundering in private companies, right? And so this thing will, have to, it'll see a lot of volatility around, any sort of reporting event, et cetera. But, they're also, for Robinhood, I'm sure they don't really care about this, but, they are charging a 2%, management fee, the same thing that I do, right?
I would argue, like, I mean, I kind of like the structure. It's kind of crazy, but we're like relative to 50 years ago, like the amount of wealth that's been created in the private markets is inaccessible to retail. And by the time company IPOs, it's like, historically companies would have IPO'd way earlier. And sort of this vehicle, if done correctly, to your point, I think will allow retail to get exposure to companies like names that they want to have access to. The question is like, I was, can they source interesting companies and how are they marking them to market? In good times, less of an issue. In bad times, I think you might see some like very big disconnect between the holding value and what you're marking it. In many ways, it's a thing you have to deal with on the venture. Like when you're marking positions for your LPs. I mean, I remember spending just more time than I wanted to just with like our fund administrator, like going through like, how do you mark this position? You're like, well, there's a last round and there's a secondary market trade, but there's an illiquidity discount and marketability discount. And you kind of have to stay consistent on that. So it's challenging.
Well, this structure is a good structure for them, and it clearly solves the problem that they had before, right? Which is that when they did the tokenized shares of OpenAI and SpaceX, you know, none of these companies actually want to sell an individual share or a fraction of a share to some, call it SPV that then will then sell a fraction to a, kind of an end consumer who can then do whatever they want with it on chain. Like the companies don't want that, but are they happy to put it into a combined fund that, gives, some distribution and access for a very small subset of their equity that is then entirely managed by a sophisticated actor like Robinhood? Like probably, because these are good retail names, right? And so this solves the problem they had before with these companies because you know we talked about this I think over the summer, but the way they had done it before, there was no way that those companies were going to continue to sell equity to them. They were going to have to keep going to the secondary market and trying to find employees and early investors who would sell, and that was very capped. Like there was just not very
By the way, some of these companies have like ROFRs, and so
correct.
there's a lot
Yeah,
of time for these
transfer
SPVs.
restrictions.
Yeah, transfer, and then, so you have these SPVs that would solicit interest in shares like Stripe. You get like $150 million of interest in SpaceX and Stripe, and then you'd have to go find a seller, and then the company would have to approve it. And anyone that is familiar with that tender process, at least for Stripe, it is impossible.
Yeah, and
But I
so
could see them selling to a stakeholder like Robinhood. That is, it's one counterparty they're facing with them, and
yeah,
they.
and it's just the fund, right? And then the fund is, publicly traded and it's fine.
Yeah,
And
because
so
I was.
it's much more scalable
Yeah, totally. Could you see Robinhood like raise like $10 billion against this?
over time, right? I mean, it depends a little bit on what happens in the IPO market. I mean, people keep staying private for so long. I mean, it's interesting, but there's been a lot of talk already this year about, okay, well, we'll have our first $1 trillion IPO this year, right? We'll have SpaceX IPO'd over $1 trillion. We'll have OpenAI IPO'd over $1 trillion. Anthropic's probably more of a 2027 story, but maybe the same thing, right?
Yeah, yeah.
And so I think that amount of liquidity going into the public markets means there's a lot of activity in the private markets. And for those of us like you and I, we see like SPVs all the time of these things as well, right? Like everybody's trying to sell to their, what they consider their friends who have enough money to invest in these things if they have a little bit of exposure. And so there's definitely enough right now. But if the IPO market opens back up and people start going public and more easily, then we'll see. But listen, I expect they'll keep doing this. I expect this will keep scaling. This is probably the first of many. And we'll have to see how infrastructure changes.
So I remember meeting one of the larger private equity funds came out here, met with family offices. I'm in the room, and they're like, "This distinction between private and public is irrelevant now." And I actually agree with that in the sense of like fast forward 5, 10 years from now, like what we've initially thought of like private and public really historically was a liquidity difference. Like you had way more liquidity in the public markets. Now you have a ton of liquidity in the secondary markets for a lot of companies. So what really is this distinction between public and private? I think it comes down to information disclosures, right? Because there's as I understand it, like the reason many companies go public today is you're accessing a different buyer out there that is pretty large. That comes with a whole set of reporting requirements that are, you know, you can satisfy, and they're very clear what the rules of the road are, but you have to kind of beef up your organization, reporting, audit. I mean, like Kraken, a lot of these companies like go through a pre-IPO process of being IPO ready, and that takes a long time, right? Um, but like, what is your view, and like, is that going to matter like in 10 years from now? Are we going to make the private public distinction as much as we are making it today? Or will we just have like it's just a liquidity game, and like, and you're gonna have to change some regulation on the private market disclosures.
Yeah, it's possible, right? So there's some data out maybe a week or two ago that shows about a third of exits for VC funds are actually now secondary transactions. And just a few years ago, it was like 5%, right? And there's now a really robust secondary transaction market where, early stage funds, by the time these companies become, unicorns, are really happy to sell their liquidity. And there's brokers and there's kind of this whole infrastructure that goes around that. People like Stripe and some of these other companies like Kalshi, I think has one, and Polymarket has one. And some of these companies, when they get to that size, they hire kind of like heads of investor relations, right? Just like they're public companies because they have, kind of a broader set of um, demands and a broader from, their investor base, and they have a broader set of equity holders. And so it's definitely happening. There's more infrastructure put up around it, but there's still this access question. There's still the laws around, do you have to be a QC or do you have to be an accredited investor? There's still, disclosure problems. And so will, the SEC want to wade into that market? Probably not. Will Congress want to wade into it? Maybe eventually, depending on if this kind of fever pitch around, kind of access. The easier thing in my mind is that you can actually just make it less costly to go public, and you can probably provide, some, additional sort of and some additional like infrastructure or like programs that incentivize going public. But we'll see. It's either way, markets correct themselves, and so we're going to continue to see more infrastructure around the late stage privates get stood up. But I do think that, or I don't see that the law is changing particularly soon.
Yeah. I want to round out the discussion. I mean, there's a couple other interesting news. You have Tether invests 200 million in Whoop.
Whop.
Whop. Not Whoop, the health thing. Whop. And the thesis there is pretty clear, right? Like Whop is going to integrate Tether so that, users, creators can hold, transact, like use USDT, because further solving the demand side of the house, right? For context, we talked about Circle earlier in the pod. Tether has 3-4 times more, you know, stablecoins in circulation, and they kind of what dominates 75% of the stablecoins in circulation are USDT. So this investment makes a whole lot of sense, right? Using their balance sheet to further entrench the usability of the stablecoin for Whop.
Yeah. It's these marketplace businesses, and these call it like, micro entrepreneur infrastructure businesses. They're growing incredibly quickly. There's a bank that kind of focuses on a lot of these people as well, called Slash, that is growing incredibly quickly. Also moving a lot of their business to stablecoin rails. They've talked about it recently.
Mhm.
I think like Whop, I think they announced in October they were doing like 150 million of annualized revenue. It's continued to grow quickly.
That's not GMV, that's net
No, that's
revenue.
revenue. Yeah, no, GMV is like close to 3 billion today, I think
Yeah,
now.
their
Yeah.
take rate is that, right?
Yeah. So, and
They have 18 million users. They're
yeah,
earning
18 million
3 billion.
users. It's very Gen Z focused. Like if you're not, really plugged in, you wouldn't necessarily know about the business. I think
You tell me I'm not plugged in because I can't even pronounce the name of this company.
well, I'll tell you somebody who used to work for Dragonfly, who I consider a friend, who's an incredibly smart guy. Actually, is like an executive at Whop now, and he was one of the I actually heard about the business first from him, and he's like he's a younger guy, in his like mid-20s, incredibly smart, and he was like pay attention, and then he eventually ended up going and working there, because like the content creators and like and Gen Z, like a lot of them are using Whop, and it's growing incredibly quickly. And so, but one of the things that we've seen in these marketplace businesses, so not just them, but a lot of them, is that they have content creators in a lot of different jurisdictions who are also much more comfortable with digital money, who are much more comfortable being entirely online, and who in some cases don't have like really robust, call it like accounting and like infrastructure, and a lot of them are very, very open to taking stablecoins, and in fact, not just open, but especially if they're outside the US, they want to take stablecoins.
I think that's where most of the demand for stablecoins is going to come. Like, if you're a content creator, you get paid in stables. You pay for certain goods and services online, like e-commerce runs by stables, and then you off ramp some amount for working capital needs of day-to-day expenses. But
Or you don't even need it anymore if you have a rain card and you pay with everything
true,
with
that's
your
right.
credit card.
So I think like this will manifest itself certainly for younger generations. But like I've always felt like part of the thesis for me coming into crypto was seeing what was happening in Southeast Asia and in Korea, like where like finance, like fintech is going, like everything apps, right? And people being so digitally savvy. I think the US is like the leader in pretty much most sectors, but when it comes to finance and fintech, it's like super far behind, right? Like domestic payments in the US, like FedNow kind of works, but it's pretty Yankee. Like Pix in Brazil, way better.
It's
Even
amazing.
Mexico has SEPA, way better. Europe, way better. Like the US somehow is like super, super antiquated when it comes to payments. And but yeah.
I mean, the US has never been at the forefront of payment innovation, right? Not since the networks. And so it's been, so I say never, but not since the networks. It's been a long time. And so um, not surprising. Congratulations to them. $200 million from Tether. I think it was a $1.6 billion valuation. I think they're going to keep growing, keep doing well. And I think we're going to see a lot of these types of businesses move entirely onto stable coins and use things like, grain cards and things like that.
Does this make you update your thesis around like investing in other stablecoin issuers? Like Tether has, for better or for worse, like one of one, and they have dominated the distribution game and their monetization game. And I would argue it's going to be incredibly hard for other people to unseat their advantage. And they're using it effectively, like really, really well. In an investment like this one, just further entrenches their position. If you're I know you've invested in other players, but what does this mean for that type of company? Like it's pretty hard to go up against Tether.
Well, I think right now, I mean, Circle is growing quicker than Tether is at the moment. And so, I mean, that's part of the stock outperformance. But I think
And
right
then
now,
double clicking on that, they would say Tether, certain financial institutions and will not accept USDT because they just don't. And there's a
yeah,
place for
there's a lot of US based businesses and financial institutions who are more comfortable with Circle versus Tether. So now, of course, the launch of USAT and the trying to be Genius compliant and working with Anchorage, their focus is on trying to get into that market and with Bo Hines. But it's the just launch, it's very early. So we'll see. You have to see how that plays out. All that said, I think to your original question, it is probably hard today to launch a new general purpose issuer with no wedge. But what we're starting to see quite clearly is that uh, if you have the ability to issue and then you can do other things, right? So Bridge obviously is very focused on this issuance being part of their business. That's why they're getting their trust charter. That's obviously has long been the story around Paxos. There's others doing the same. You can build probably a really interesting infrastructure business that has your own stable coin or also maybe is able to white label. We saw a little bit of the OCC guidance today around how white labeled issuers can share revenue with these platforms. Now, you can't share the yield. According to the first guidance from the OCC, you can't share the yield to the end customer, which is a issue that we need to try to figure out with the OCC, but there's so clearly like revenue share between the white label platform and the company. And so I think we're going to just see a big proliferation of people who are issuers, but who are do other things around payments, other things around fintech, provide really interesting platforms. And that's where we've seen almost all of the other challenger issuers move over the last year. And some of them have been a little bit more quiet about it, but you'll see a lot of really big announcements
yeah.
about that, like this year, I think.
What happened? I want to round out the discussion because I mean, there's other news on the margin, but talking about Stripe again. Like, didn't they? Someone flagged me earlier around the OCC is officially shutting down the creative loophole engineering around stablecoin interest and rewards. For months, issuers thought that they could bypass the statutory provision on interest by rebranding yield as staking rewards or loyalty tokens. Today, the OCC signaled that the game of musical chairs is over. Obviously, clearly biased and whatnot. But you're all, you were in DC earlier. I don't think it's as clear as this, but uh,
So what happened, to be entirely clear, is the OCC put out a request for comment today, right? And in their request for comment included the initial rules that they were going to that they think or that they want for discussion for what they would put on Genius and its compliant stablecoins, right?
yeah.
And so so everybody knows, or just for context, when Genius was passed, a big part of that law was that, hey, listen, like there's these things that we're defining. Then there's a bunch of things that we're not defining. And the OCC has until January of 2027 and with Treasury to go and define what the rules will be. Right. And so the OCC put out these rules and says, hey, we want this request for comment. And in that was a very, very tight definition around what how yield could be passed on to the end customer, if at all. And they basically said you can't pass on yield to the end customer. So the issuer can pass on yield to another company, but you can't if you're a white labeled issuer, but you can't pass on to the end customer for holding, using, or retaining stablecoins. Right now, I talked about this before, but that is like extremely regressive because right now there is a lot of fintechs who are going to in some way give cash back or going to in some way give money back to their users and rebates or whatever for using their platform, right? That exists already today. This is not a stablecoin point, right? When you swipe your Chase Sapphire, you can get 2% cash back, right? So this
Yeah,
idea,
but that's a credit system, though.
but you get there's a
Yeah.
lot of different systems where you can get. I mean,
No, I hear you loud and clear. But like, so I've looked a lot into like what is the incentive for you like B2C payments. The credit card networks are so entrenched because like businesses are subsidizing the rewards to you.
no, but this isn't a network point. The issuer is the one giving those rewards back, right?
Right,
The
man.
bank is the one giving those rewards back.
Yeah, they're giving you those rewards in the way of like you know airline miles or cash back.
67% of Americans prefer getting cash back to any sort of other type of thing. And most of these cards are now moving to entirely cash back because that's what the consumers want.
Yeah, correct. I would say definitely agree with you on that. I think the reason why there's a lot of pushback here is because banks feel threat around
Yeah,
deposits.
that's the whole reason.
That's the whole reason. I mean, like I calculated if if Americans were to earn the yield on their checking and savings accounts, that the entirety of like deposits sitting in America, like in these checking savings accounts, basically earning 0.3%. Banks were clipping 3 to 5%. If all of that net interest income were to flow to consumers, that's equivalent to a COVID stimulus check for every household in America. People can look at our wonderful insights tab in our website, virgincap.com, and we look at these things and we say, yeah, that's massive, and not surprising, you have pushback on the stablecoin paying out yield. It's pretty, I think we touched on this in the discussion with Rebecca. I don't remember if she said it in the pod or I remember just having a conversation with her. It seems to me like the definition is fairly broad, in the sense that, like, if you're a business using a stablecoin, and Rob, I'm sending you, like, for instance, if I'm sending you money and it's via stablecoin and there's like money in transit or whatever, I can earn yield on that leg. I don't think they have an issue on that as much as an issue on Coinbase paying out yield on deposits, right? Because the end game here is Coinbase effectively could like really use this to grow their deposit base, and who loses there? Obviously, like a large financial institution that's not paying interest to their consumer, right? But
Yeah,
my
there's
understanding is
people
like
that lose
if
for
it's
sure.
an idle stable, like if it's a stablecoin sitting in a wallet, they have an issue with that. If it's a stablecoin that is being used for some like business purpose, they don't have a problem with that earning yield. At least that's my understanding. Of course,
No, no. So that's no longer true in this OCC guidance. So that's the problem, right? Is the so there's a couple things that have happened, which is that the banking lobby was completely out to lunch when Genius got passed, and so then they were started to catch up, and so then they said, okay, well, in clarity or some version of that that's coming out of the Senate, we're going to write some law that is going to remake the way we think about yield, and that the language in that was basically that you can't pass along yield just for holding the stablecoin. And Coinbase came out and they were against it, but some of the rest of the industry was like, okay, well, that's fine because you can still give rewards for using it or et cetera. But that became a big hot topic because Brian tweeted about it and got everybody up in arms. And so we've been debating it, as part of the market structure bill. Well, then this comes out today, And the language is even harsher, which is that, you can't pass along yield for holding or using the stablecoin, right? And so now all of a sudden it is extremely regressive, right? And this is basically just being done to protect the banks and to protect their, their interests.
As much you and I love stablecoins. Is this a nothing burger? Like, I get the yield is amazing to be able to pass through. I don't think it's marginal, but it doesn't derail the use case and the power of using a stablecoin. Like,
I think it doesn't derail a lot of the use cases, but what I do think it does is it makes it with and the banks know this, right? This is why the banks are scared shitless. Because with an ability to have better payment rails and to serve the customer more with better product and to pass along more, economics to them, almost every fintech and digitally native bank was gonna move to stablecoin rails. I see it every day. Everybody I talk to, there's not a fintech in the world that you could tweet at me, and there's not a fintech in the world that isn't actively building for stablecoins right now. Okay? And a lot of the banks are starting to build for that, right? But if you can't take full opportunity of serving that customer better, right? Then, it makes it a lot harder for those fintechs to then go and decide that they're gonna be entirely on stablecoin rails. Like, it protects this kind of like lipstick on a pig thing that it kind of exists already in banking as a service. Now, there's a question around, okay, well, it's a nothing burger because maybe what happens is, you don't hold the stable coins, but then you have a tokenized money market fund, and so you swap into that or something, right? But, these products are not as good today and for a number of reasons, because most of the tokenized money market funds, if they pass along are securities, right? And so then there's a KYC point, and so it's not you can't necessarily trade it non KYC, at least in the US. And so, I mean, clearly, what is happening here is the banks are trying to figure out a way to slow down the rate of adoption because they are losing customers, or they're at least worried about losing customers in the future. And so, I don't think. Listen,
like no predictions or predictions, but how damning is this? Does it set us back? Like 20-30% of the institutions that we're now exploring stablecoins are going to say, you know what, the ROI is no longer there. Does it set us back a few years, or is it just, kind of curious what the impact is? Because it is like
I think
five.
it slows down the rate of adoption.
Got
That's
it.
what I think happens. It slows down the rate of adoption.
Isn't
Not
that good for a circle that is already entrenched, and it doesn't
Yeah,
seem.
it's good for the incumbents, and it's bad for innovation, right? It's bad for the consumer. I want the I'm altruistic. I want the consumer to do better, right? But also, of course, like if the consumer does better, my portfolio companies do better. But so not maybe not that altruistic. But I will say, listen, like I mean, there was a Senate banking hearing on this morning after this came out, and there were a number of senators who asked about this. So I think Bill Hagerty asked about it, Bernie Moreno asked about it, and and Gold did say, he's like, listen, like this is a proposal, like it can be approved upon, and so the whole industry needs to kind of rally around this, and if we need to, I do think that if we need to be more thoughtful or, negotiate a little bit more on clarity to make sure that we allow for innovation in payments in the US on stablecoins, and we allow for issuers to be onshore. Because this, as written, by the way, will push more issuance offshore again. It's probably better for Tether than it is for Circle, if this goes through.
Because in
I
this,
don't think it's what the government wants.
for what it's worth, Whop creators will be able to earn yield. Well, Tether doesn't share that anyways.
No, that's not true. So what would happen, the way it's written right now, is that Tether could pay Whop, but Whop would not allow to be able to pay their creators.
Correct. Yeah, that's right.
Yeah.
But Tether is not paying Whop.
Oh, no, they're not. That's not what Tether's business
That's what I'm saying.
Yeah.
So this is the point that I'm trying to make. Like, I get that yield is important, but let's not forget that consumers have been banking the way that they've been banking for a century plus, where they have not expected, they don't expect earned yield. Like, you look at consumer behavior, like you could say rates went up and you would have assumed that a lot of those deposits go to money market accounts, but they just don't. And because people are lazy and financial literacy is low, and maybe you could say, look, the system's designed to be hard to move your money and hard to open accounts, and now you're moving to a world of like um, accountless fintech, which is just wallet based. But I do think that even Tether is a pretty clear example of an institution that has been dominating the stablecoin game. You could argue that they were first and whatnot, but they don't pay a yield, and people use Tether because it's a in my mind. I go back to to round out the conversation. Why did Terra collapse as a liquidity issue and usability issue? Tether is dominant in, like, you go to Hong Kong, you go to Argentina, you go to Africa, like, just Tether is embedded, and they, as long as they continue to do that, I think for them, they don't care. In many ways, this is great for them because Tether's market share probably continues to, they have a bigger moat if other stablecoin issuers can't pay out yield because they haven't and they don't pay out yield. So it's great for that.
The one thing I would say though, right, is Tether has this, they're competing, right, and they've built this business and they've had a great moat. Um, the banks are trying to protect themselves with a regulatory moat, not with a, hey, just like, what does the free market want, right? Tether is obviously just competing with the free market, and so listen, we can round this out. We've kind of beat this to death. Uh, my mind, let people compete, right? Stable coins are inevitable. I fully agree with that. I was texting somebody at one of the leaders at call it a large GSIB yesterday, who was we were talking about this exact thing, and I said same thing to him. Stablecoins are inevitable, and I think the GSIBs are starting to understand that as well. But the question is if they're inevitable, how quick is the rate of change, and who ultimately is it? Are the incumbents able to put their arms around it and squeeze the innovators out, or are the innovators going to win? And this is just something. This is an attempt by the incumbents to squeeze out the innovators, right? And we should always be pushing against that and be allowing for more innovation to happen in the US.
What would you say the counter argument to this is? Hey, maybe stablecoin issuers should not be paying out yield, and they should not be going out on the risk spectrum of owning treasuries. They should be 100% collateralized, and the collateral should be pristine. It should be a dollar backed 1-to-1 in a bank account, and even though they're going buying treasuries where their yield is coming from, that has risk. So this is consumer deposits. Like, what would you say to that?
I mean, the genius already does that, right? You have to have really pristine collateral. It tells you how the collateral
Pristine
works.
collateral, but there's a school of thought that says, like, fully 1-to-1 cash, like, no.
That is, I mean, not cash, but you can have like money market funds and they have other types of collateral, and there is a mechanism in there for looking at or approving new types of collateral.
Little Capital One requirement. Like, banks are regulated for this reason. Like, they're basically rehypothecating the collateral.
Yeah, they're rehypothecating collateral, and they have capital rules, right? Now the banks are, they're fighting capital rules right now, right? They're trying to get Basel rolled back at this moment, right? And so, like, and I think there wasn't a big announcement. We didn't talk about it, but the brokerages can now use stable coins. They only have to take a 2% haircut instead of a 100% haircut, right? Which is similar to money market funds.
Is that rule now, or is that proposed by Caitlin?
No, I think that rule was enacted, so they put that out there. So, so you're going to start seeing, like, a lot of people a lot of these brokerages and FCMs want to use this as collateral, and so look, this is happening, and so the fight right now is, do we allow innovators to continue to innovate on shore or not? That is the full fight, right? And like right now, we're seeing the gas of the banks trying to make sure that they protect their fiefdom, and that is net bad for America. It is net bad for consumers. It is net bad for all of us.
Yes, sir. I'm telling you, it's a COVID stimulus check that's in there. And hopefully, hopefully, round out this probability of it going back to a more beneficial treatment and paying yield.
If it's in there now, it's probably going to end up being in there. So we're going to have to, really put our apparatus together to try to figure out a way to take it out. But I will tell you, the whole industry will be focused on this. And we've shown to be, an industry that can get things done in Washington. And so hopefully we'll be able to do that here. But so what I don't know what the poly market is today, or if there is one yet, but I'd put it at 60% it stays in.
Yeah. All right. Well, what's content of the week?
Can I tell you, last week I said Olympic hockey. I don't know if you watched the gold medal match on Sunday morning, but the US won the gold for the first time since 1980, since the miracle against the USSR.
You go to overtime?
It went to overtime. It was an incredible game. They scored a game winner in 3-on-3. The guy who scored the game winner had his tooth knocked out. He was bleeding from his mouth while he scored. This is like a
Yeah.
thing of lore.
Movie will be made out of this.
Yeah, it has to be,
Yeah,
look,
I love hockey. I think I watched for the first time in Madison Square Garden because time was
that's where the Rangers play. Yeah.
amazing. I think it's the most fun sport to watch live in an arena.
It's so fun live.
Especially because I was there like banging. I got comp seats and whatever, and it was like, wow, it's so much fun. I would also say Olympics is I love freestyle. I
Yeah.
love skiing, and so one of my friends from college, her sister does aerials, and I got invited to go see her in Pyeongchang, which in South Korea,
Yeah.
like 10 years ago. And she competed back then, and I was like randomly scrolling through and I saw her, and I saw the clip of her winning silver, Danielle Scott, and it was like Australian. It was like kind of Australia for whatever reason has like a super strong aerials program.
Yeah.
And it was just amazing to see that. It's like they do like that nerve-wracking, but it was fun to watch the Olympics.
New content for this week because the Olympics is still on, but
No, they're done though. The Olympics is
oh,
done.
yeah, just finished. It just finished, right? Yeah. But there's a movie called Sarat, which was nominated for the best international feature at the Oscars, and just saw it, and it's sort of movie about a father and a kid looking for his son, and they kind of end up having to go, and they're trying to find them at this like desert rave. And I will tell you, movie is a trip. So like it is
If you're
like
saying that movie's a trip, I can't imagine what other people think of it.
it's insane. But it was insane in a way that I liked. So if people like kind of weird, kind of movies that will, get your heart rate up, like I would recommend this.
Yeah. I'll say two things. One, Invest Like the Best. I was just catching up. There's two really good podcast episodes. The one of Josh Kushner.
It was great. I agree with you.
It was great. It was very good. And then the D1, Dan Sunheim, I think he used to be a CIO Viking, started this fund. He talked about how they kind of he got into kind of during COVID, I think GameStop phenomenon, like their fund was like going through a hard time. And just I really appreciated like his conversation around that and how he managed that. So those two podcasts were pretty good. And then, I mean, there's Michael Burry's Substack is amazing. I think he's making like 20 million bucks off of the subscriptions at this point, more than most fund managers on management fees. Pretty good, honestly. I mean, I subscribe to it. He has some pretty good content. His one on Palantir was pretty eye-opening. So I would strongly suggest people to go and subscribe to that. It's not cheap. I think it's like $300 a year or so, but it's pretty awesome content.
All right, another great week of stablecoin news.
We somehow managed to make it sort of more interesting than us. There's a lot of time the podcast we come in here like, God, I don't really know there's anything to talk about, but somehow we managed to make it on stablecoins again. It was pretty entertaining.
Don't get me started on stablecoins. That's and then we go an hour and 20 minutes. So
that was good, man. All right, good places ever to end it. Thanks everyone for joining. We'll see you next week.
Thanks everyone.